It always starts with reassurance. Markets at all-time highs, headlines promising a soft landing, and an endless expert confidence. But throughout history, that was the precise moment when insiders were already quietly fleeing. While the public is told everything is fine, the real crash is being engineered out of sight. Why does no one warn you until it is too late? The answer and the coming fallout will change what you believe about boom and bust forever. The calm before every crash. Crashes don't begin with chaos. They start with confidence. Markets near all-time highs, positive news headlines, soft landing narrative. The public is told everything is fine at the exact moment risk is highest. Smart money. Exits. First, institutional selling spikes while retail investors keep buying. Insider selling data hits extreme levels before crashes. Show how in 1929, 2008, and today, the rich exited weeks before the collapse. Liquidity disappears. Overnight, banks quietly tighten lending. Credit becomes harder to get. Borrowing costs spike. When confidence breaks, markets fall all at once. The public gets blindsided. People check their accounts after the damage is done. Media suddenly switches tone from soft landing to recession panic. Narrate how ordinary families become collateral damage. Wealth isn't destroyed, it transfers. During every crash, assets move from the panicked to the prepared. The rich buy distressed assets at 70 to 90% discounts. Example, BlackRock bought entire neighborhoods in 2008. The real goal, control, crashes reset asset ownership, not the system. Debt plus inflation plus crisis equals dependence. The crash is not a failure, it is a mechanism. The signal happening right now. Massive institutional selling, credit tightening, record high consumer debt, interest rates suffocating the middle class. Conclusion, this crash is not coming. It has begun. The only choice is whether you panic or prepare. Television anchors beam as the closing bell rings. Headlines scroll across the screen. Dow at record highs, economy on track for a soft landing. Experts see no recession in sight. Wall Street strategists appear on morning shows, repeating the same refrain. Growth is steady, inflation is cooling, the worst is behind us. The message is uniform and relentless. Record highs. The Federal Reserve's latest statement promises a gentle return to normal, with officials insisting that risks are contained. Stock indices hover near all-time peaks, and the S&P 500 posts its strongest quarter in years. Magazine covers feature smiling CEOs and bold predictions for the next bull market. On social media, influencers share charts and optimism, urging followers not to miss out. Optimism spreads through feeds and comment threads. Every data point, every soundbite, every official forecast works to reinforce the mood. Confidence, not caution. Confidence. Yet beneath the surface, this is the moment when risk is at its highest. The public is told everything is fine at the exact moment danger is greatest. Danger. The calm before every crash is not an accident. It's a feature, not a bug, of the cycle. A man in a crisp suit takes investment tips from the shoe shine boy at the corner stand. In 1929, Joseph Kennedy watched this scene unfold and decided it was time to sell. The crowd's excitement and the wild stories of easy money were not signs of strength. They were signs of danger. When everyone is certain the future is bright, when strangers brag about stock picks and fortunes multiply overnight, something vital is being ignored. The more confident the public grows, the more invisible the real risks become. Confidence makes danger hard to see. In coffee shops, office break rooms, and online forums, the same optimism echoes. The market is safe, the experts are in control, and there's no need to worry. Optimism fills the air. But beneath the surface, those with experience sense a shift. They recognize the pattern. Euphoria before disaster. The term for these quiet movers is whispered on trading floors. Smart money. They do not argue with the crowd. They do not issue warnings. They simply act, leaving the party early while the music still plays. The question is never what the headlines say, but who is already slipping out the back door. In every major crash, the first to leave are never the loudest. They move in silence, using legal filings and complex trades to slip out the back door. In the months before Black Tuesday in 1929, Joseph Kennedy and a handful of Wall Street insiders quietly sold off stocks, their actions lost in the noise of public optimism. SEC records from 2008 reveal the same pattern. Form 4 and Form 144 filings show chief executive officers, chief financial officers, and board members unloading billions in shares. $11 billion in insider sales across S&P 500 firms in early 2024 alone echoed levels not seen since just before the last crisis. Selling peaked in silence. While retail investors poured money into the market, institutional giants executed block trades and hedged portfolios with S&P, put options and credit default swaps. Institutional selling spiked while the crowd kept buying. Hedge fund form, 13F filings from late 2023 document a surge in short bets and tail risk hedges, all while public statements remained upbeat. These clusters of insider selling and derivative hedging always appear weeks before headlines change. Weeks, not days. The rich do not wait for alarms. They follow the filings, not the forecasts, and exit, while the crowd still believes the party will never end. Banks don't ring bells when they pull back. The warning comes in terse internal memos and the numbers buried in Federal Reserve surveys. In late 2025, the Senior Loan Officer Survey recorded the tightest lending standards in more than a decade. 77% of banks reported stricter terms for commercial loans, with nearly 9 out of 10 tightening credit lines. The language is clinical, but the effect is immediate. Funding for businesses and households dries up almost without warning. Borrowing costs spike as lenders demand higher interest and bigger collateral haircuts. In the repo markets overnight, rates surge to levels seen only during past panics, and spreads between safe and riskier collateral widen past 50 basis points. Commercial paper issuance drops sharply, shutting out companies that rely on short-term funding to stay afloat. Liquidity doesn't fade gradually, it vanishes. The system's plumbing seizes, and the invisible flow of money stops. By the time headlines catch up, the damage is already done. The real crisis begins when confidence in the system's ability to provide cash on demand quietly evaporates. Institutional selling is reaching levels not seen in a generation. In October alone, insider sales at S&P 500 companies totaled nearly $6 billion. Executives were dumping shares at a pace 33 times higher than their own purchases. Hedge funds are piling into defensive trades. Put option holdings among the biggest players now top $80 billion, and credit default swap exposure has surged to a post-pandemic record. Banks are slamming the brakes on lending. The latest Federal Reserve survey shows over 40% of banks tightening standards for business loans, and more than half are clamping down on commercial real estate credit. Consumers are feeling the squeeze. Household debt has climbed past $18 trillion, with credit card balances at all-time highs and serious delinquencies rising fast. The middle class is suffocating under the weight of high rates, mortgages average more than 7%, and credit card annual percentage rates have spiked to nearly 23%. These are not distant warning signs. They are the present reality, unfolding in real time, and every official report confirms it. A family wakes up to headlines screaming, "Market plunge wipes out trillions." Their retirement savings, once a source of comfort, have been gutted overnight. The day before, their newsfeed promised stability. Now, every channel runs stories of layoffs and fear. Bank statements show balances slashed, while mortgage payments stay the same. The phone rings with calls from worried relatives. This is personal. College plans are put on hold, vacations are canceled, and the family car may have to go. Across the country, millions experience the same shock. Survey data from 2008 and 2020 reveal that most households first learn of a crash only after the worst losses have already hit. The media, once confident, now stokes panic. For ordinary people, the damage is done before they can react. The crash is real, and it is personal. Behind closed doors, a different scene unfolds. Cash-rich institutions enter the market with precision, snapping up assets at prices that would have seemed impossible only months before. In the aftermath of 2008, entire neighborhoods in Florida, Arizona, and Georgia changed hands, not to families, but to firms like Blackstone and BlackRock. Public records show these bulk purchases often happened at 30 to 50% below pre-crash values, sometimes deeper for the most distressed properties. Bank portfolios of foreclosed homes, once symbols of the American dream, became inventory for the highest bidder. The same pattern repeats in equities and bonds. As forced sellers flood the market, those holding reserves quietly accumulate assets at fire sale prices. The official story is about loss, but the reality is transfer. Wealth does not disappear. It moves from the desperate to the prepared, from the many to the few. Every crash is presented as an accident, but the outcome is always the same. Ownership resets upward. After the dust settles, the same hands hold more of the assets, while the public is left with the debt. The 1998 long-term capital management bailout set the template. In a closed-door meeting at the New York Fed, Wall Street's biggest banks were ordered to rescue a hedge fund whose collapse threatened the system. No public money changed hands, but the lesson was clear. If you're big enough, you get saved. This cycle breeds dependence. Debt and inflation squeeze the middle class, while each crisis tightens the grip of those who control the flow of credit. The crash is not a failure. It is a mechanism. Ownership consolidates, risk is socialized, and the public is told to trust the very architects of the last disaster. Debt plus inflation plus crisis equals dependence. Right now, institutional selling hits records, while headlines urge calm. As debt and rates crush the middle class, assets quietly shift hands. The crash is not an accident, it is a transfer. The only real warning is this: in every engineered crisis, those who see it coming decide who owns tomorrow.